At the Africa CEO Forum, investment firms had an explicit preference for companies with a proven track record, cash flows, and a tested market. Finding an investor seeking greenfield opportunities was quite rare. Most capital on the continent tends to go to either well-established firms or those starting out, which is the domain of venture capital firms. CGTN's Ramah Nyang spoke to the head of Quantum Global Research Lab and explored why the fund loves taking on greenfield investments.
You've got quite a bit of capital to deploy across Africa. And unlike everyone else that we've spoken to here, the majority of investors here, the majority of funds look at projects and say, well, has to be a business I can get into, that's well established, has a proof of concept, has revenue, has cash flow that I can work with, that I can exit in 5, 10, 7, 8 years. But you do the opposite. You're going to greenfield projects. Why?
Yes, we like greenfield projects because that's where you get the best uplift in terms of returns over time. So we go into project development, roll up our sleeves and put it all together, make sure that it gets to bankability so we can share it with others, but also invest our money as well. We do that because we look at NAV, net asset value uplift, and the usual other metric that you look into when you invest, and you get the best uplift usually from a greenfield project if you run it well. But it also means that you have to have a very strong active management role within the firm, because once you invest and you pull that trigger, someone has to manage the project. So either you have a team internally or you've got an army of consultants or externals that you contract and manage tightly to do that. We have the latter. So we hire people from outside to work with our team. We do have some brownfield projects in the hotel space, for example. Depending on the country, the sector, we may spot a nice opportunity on the brown field stage, but really we prefer greenfield projects.